So Europe is building some absolutely world-changing technology right now. But there's a catch. A huge chunk of the profits are flowing overseas. It's this massive vulnerability that's kind of hiding in plain sight. So today, we're going to break down a surprisingly simple idea for how Europe can fund and, actually own its own future. Okay, let's kick things off with a really big number. $3.5 trillion. That is the staggering value created by European tech companies that were backed by venture capital since 1990. Now, this isn't just some number on a slide. It's proof. It's a clear signal that Europe's innovation engine is absolutely running hot and building companies that can compete anywhere in the world.
And this isn't just a thing of the past, it's actually speeding up. The European tech boom is for real, and it's being fueled by a deeper pipeline of amazing, promising companies than we have ever seen before.
I mean, the ecosystem has some serious depth. You got to picture this giant innovation funnel, right? At the bottom, you've got over 50,000 startups. From there, thousands of them mature into breakout companies, and then over 1,600 become true global contenders. But honestly, the most important part is the people. Every success story creates a whole new generation of experienced founders and engineers, and they just start the cycle all over again, only bigger and faster each time. But here's the catch. As these companies get bigger, as they need more fuel to grow, look what happens. The source of their money, their capital, it just shifts dramatically. They become more and more reliant on investment from outside of Europe, mostly from North America and Asia.
Now, this isn't just some, weird feature of the market. No, it's a fundamental problem. This dependency creates what you'd call a strategic vulnerability, and it goes way beyond just money. You can think of it as Europe's leaky bucket. All this incredible value is being created by European talent, but the financial returns, they're flowing straight out of the continent. And that wealth isn't being reinvested back home. It's actually making someone else's economy stronger.
And we're not talking about a small leak here. The funding gap every single year for these really crucial later-stage companies is estimated to be around $30 billion. That's how much money is needed each year that just isn't coming from inside Europe. This is exactly why leaders like the former head of the European Central Bank, Mario Draghi, have been raising the alarm. He argued that technology isn't just about making things more efficient. It's about strategic autonomy, being in control. If you can't fund your own most important industries, you are pretty much handing over the keys to your own future. So the big question is, where in the world could this $30 billion a year come from? Well, turns out the answer is not only available, it's enormous, and it's been hiding in plain sight this whole time. Let me introduce you to Europe's sleeping giant, its pension funds. Altogether, they manage a staggering $15 trillion. And this isn't some abstract pot of money. This is the real, long-term savings of millions of Europeans, money they've set aside for their own futures. Okay, so check this out. Of that $15 trillion, how much do you think is invested in venture capital? The very thing that funds all this innovation? A tiny 0.04%. It's a slice of the pie so small you can barely even see it. This isn't just a missed opportunity, it's a strategic choice that has massive consequences. So, why is that number so incredibly low? Well, it pretty much comes down to different philosophies and different countries. Many of the biggest pension systems, like in Germany and France, are built to be super risk-averse, right? They're all about predictable, safe returns. But then you have models in places like Denmark and the Netherlands, which are designed for the long haul, allowing them to embrace investments with higher risk, but also much higher potential returns like venture capital. This quote from Warren Buffett just perfectly captures what European savers are missing out on. He's talking about the power law of tech investing, where a tiny handful of massive winners, like Apple, generate almost all of the returns. By putting basically nothing into this asset class, European pension funds are just opting out of the single greatest wealth creation machine of the last few decades.
All right, so the problem is crystal clear, and we found this massive pool of capital just sitting there. So what's the fix? Well, it turns out to be surprisingly simple, but incredibly powerful.
The proposed solution isn't some super complex top-down policy overhaul. It's just this: a simple call for European pension funds to put just 2% of their assets into venture capital. That's it, a tiny little shift in their overall portfolio. So what does that 2% actually get you? It unlocks $300 billion. Just let that sink in for a second. That simple little portfolio tweak closes that $30 billion annual funding gap 10 times over.
It could single-handedly transform Europe's entire innovation economy and basically secure its technological future.
Okay, let's tie all of this together. Europe has proven it can build world-class tech companies, period. But by not funding their growth, it's letting all that value just leak away, creating a real risk to its own independence. The irony is just amazing. The solution isn't some foreign bailout, it's sitting right here at home, in these pension funds. A tiny 2% shift could be the switch that flips the entire ecosystem from one of dependence to one of dominance.
And that brings us to our final thought. The talent is here. The innovative companies are here. And, as we've seen, the capital is definitely here. The only question left is whether Europe's leaders will connect those two dots in time to shape the next decade of global innovation and growth.